Well, hello, everybody. Welcome. Thank you for tuning in. I hope it's been a great session so far on the second day of the REDeFiNE conference. The panel I have before me, and it's an honor actually to moderate this panel, are four OGs of the space. They're four of the most prominent OGs that you will come across. And today's topic, however broad, is navigating the crypto landscape. We're going to look to these crypto VCs, these founders, to find out what really their thoughts are on the space, where we've come from, where we are now, and where we're going to go from here. My name is CJ Fong. I'm with GSR and I run the sales teams for APAC and EMEA. I would love it for each of the panelists here to please introduce yourselves and your funds. What I would also love to hear from each of you is what you feel is a differentiating factor when it comes to your respective funds in terms of the approach that you take. More interestingly for our viewers and on a more personal note, would love to know how long have you been in crypto? And more interestingly enough, how did you actually get into the space? So without further ado, Jason, would you like to begin? Jason Choi.
Sure. Which one?
Yeah, that's why Jason Choi. So
There's two of us. Yeah, thank you. So my name is Jason Choi. I am the co-founder of Tangent. So we are an angel fund based here in Singapore. And what sets us aside is that we are a prop-based evergreen fund. So what I mean by that is we support projects all the way from pre-seed, seed, and then we're going to buy your tokens in liquid markets as well. And we're very bespoke in terms of who we work with. So we try to not work with more than 5 to 10 projects a year and really provide the very hands-on approach. In terms of when I got into this space, I think it was 2017. I can't do math, so that's X number of years. So very excited to be here with friends and learn from all of you guys.
fantastic. Don't worry if you can't do maths. In VC, everything goes 50x, you're fine. That's how we calculate these
Exactly.
things. Over to you, Paul.
Hey everyone, my name is Paul Veradittakit, and I'm the managing partner at Pantera Capital. Fun fact is I'm actually Thai, so really appreciate SEB for really putting this together, Cop and Cop. But Pantera Capital is one of the first institutional investors to be investing into crypto and blockchain. We manage about $5.5 billion doing both equity and tokens, early stage and later stage pre-TGE rounds. It was started by Dan Moorhead, who used to be CFO, head of global macro trading and Tiger management. So he comes from the TradFi global macro side of things. I guess we have a little bit of history. We've been investing into crypto since 2013. So we launched the Bitcoin fund, and it was a fund that was actually solving one of Dan's problems. He was trying to buy a few $1 million of Bitcoin at Coinbase, and they wouldn't let him do it. It was kind of over the daily limit of $50. So he emailed Coinbase, and this guy, I don't know if you guys know him, Olaf Carlson Wee, was actually doing customer support for Coinbase at the time. That's kind of like how long ago this has all been. But we were buying Bitcoin when it was like $50, and now we have over 200 investments all around the world. I got into Bitcoin actually around 2013. My career has really been mostly in venture capital. Now I started off on the startup side doing business development. Before that, I was doing economic consulting, and then I was doing VC focused on mobile apps and mobile infrastructure. So kind of got in early on sort of like the mobile revolution. And for the last 10 years, I've been just managing investments for Pantera. I guess the last question that you guys asked was around sort of differentiation. I mean, I think starting in 2014, there wasn't really much platform in crypto. It was just kind of the traditional VC stuff, like, doing business development, but along the way tried to figure out what's most helpful to crypto companies and then sort of build a product around platforms. So from a table stakes sort of angle, we do the normal hiring and tokenomics, research, governance, regulations, all that kind of stuff. But I'd say where Pantera really stands out, actually not as good as, I feel like Dragonfly is probably a little bit better, but we do a lot of cross-border global stuff. And then we also have a long-short hedge fund, which is different than a lot of other folks. Like a lot of folks just do privates. We do a lot of liquids too. And then we've also done something a little bit more recently called special opportunities, where, bear market, a lot of I guess anti-diamond hands. And so we kind of go out there and try to buy a lot of secondaries from folks. And that's been a good strategy for us.
Love it. Thank you very much, sir. Jason Cam, over to you, sir.
Thanks. I'm Jason Cam. I'm the founder of Folius Ventures. I'm probably the in terms of the crypto tenant, I'm the youngest. I we started a fund in September of 2021. Um, we are a evergreen hedge fund vehicle, actually. I think versus other funds that are here, we span across liquid tokens as well as private investments. Um, Typical check size for us is $500,000 to $4 million, and then in the liquid token front, we can go as large as Bitcoin, Ethereum, and as little as some meme coin on base. Um, I think versus other funds out there, what hopefully sets us apart is historically we've spent a lot of time looking at APAC projects and APAC founders. Historically, 70 to 80% of what we've backed come from this side of the world. And by their nature, a lot of them are to consumer products, in particular application and gaming. So when founders are building those things in this side of the world, we tend to usually get a look. I think that's kind of what separates us. I started day trading crypto in my spare time in 2019, made some money in DeFi. I think I met most of you on crypto Twitter, and some of you really convinced me to jump in full time. So it's great to be here.
Fantastic. And last but not least, Haseeb, sir.
Yes, I'm Haseeb, managing partner at Dragonfly. So Dragonfly is a global crypto VC firm. We manage a few $billion in AUM across multiple funds. I'd say what differentiates us from a lot of the other funds in the space, I mean, everybody you have right now on the stage has a big presence in Asia. We do as well. I think we're kind of known for being very cross-border. We have a big presence in Asia, both in Singapore and Hong Kong, as well as in the US, which is, of course, in some sense, a lot of the applications and the market infrastructure tends to come from Asia, whereas a lot of the technology development, a lot of the protocols end up getting developed in the West, and we try to bridge the gap between those two. So, my own background, I was a software engineer before I came full-time into crypto in 2017. Came into the space originally, worked at a company called 21, which got acquired by Coinbase. And then I started a startup and then eventually found my way onto the investing side. Originally had a fund called Metastable, which was also a hedge fund, but then eventually found my way to Dragonfly, which is a more pure play venture. So that's how I find myself today as a venture capitalist.
Fantastic. Well, there you have it, ladies and gentlemen, the distinguished panel that we have before us. So let's jump right in. Obviously, a lot has happened in the crypto space. A lot of growth, a lot of ups and downs, highs and lows. It almost feels like watching an action movie that's just nonstop on adrenaline. How would you actually describe the VC investment landscape evolving over the last few years, both from the VCs which are coming to the fore, as well as the market itself and how that has actually affected VCs and the way they approach it? Jason, Choi, do you want to kick us off, sir?
Yeah, sure. I think one of the more notable changes is the size of capital allocators in this space, right? So I remember back in 2018, a 100 million fund was considered a massive, massive entity in crypto versus now, everybody has a $100 million fund for some reason. So it's pretty amazing to see just how much capital there is to support experimentation in this space. At the same time, I think that opens up an opportunity for someone like us, which is much smaller in scale. We try to focus on kind of the pre-seed to seed stage where bigger allocators might not kind of have investments that fit their mandate or big enough for them to deploy. So we actually found this to be quite an interesting kind of blue ocean that not too many people are wading in. So it ends up being kind of having us be very, very complementary to bigger VCs because we come in, we work with the early stage kind of smaller bets. We kind of help them craft their go-to-market. And then when they get more mature, we can then raise money from kind of the big boys in crypto. So I think that's one of the more notable changes. I'm sure there's a few others as well, but I leave it to others to talk about.
Open to the floor.
I think there's I think over the past 4 or 5 years, and Paul and Haseeb will know better, the rounds has gotten down to a bit of more of a science because I felt like in 17, 18, you kind of just ICO and be done with it. And now it's like pre-seed, seed, Series A, and then angel KOL rounds, and then centralized exchange listing. And there's like an NDR you kind of have to do now to make sure liquid funds buy your tokens. So I think this space has gotten a lot more structured, and there's almost like a narrative you have to fit in a box to be like the first mover in some lane. That's how you get like billion-dollar type FDV that I don't think existed like 4 or 5 years ago. So I feel like it's a little more structured than a couple of years ago.
Fantastic. Haseeb?
Yeah, I mean, if you're talking about the story of venture capital over the last, 4 to 5 years, yeah, there's been a lot of market evolution. If you're talking about 2 to 3 years, it's hard to tell that story without starting in the 2021 cycle when basically the crypto space was just awash with venture capital. So this was the ZERP phenomenon, zero interest rates, where every single growth fund, every generalist fund was investing into crypto. And there was this widespread belief that crypto is here, the future is now, we're all going to be living in the metaverse, everything is going to be an NFT. And more or less, the entire venture capital and tech world was kind of buying this thesis. And you saw huge amounts of capital deployed by SoftBank, Tiger, Coatue, Sequoia, to say nothing of the crypto native VCs like the A16Z cryptos and the paradigms. But I think what you saw over that cycle was one, a lot of misallocation of capital. Like a lot of capital went into the FTXs of the world, the BlockFis of the world, the stuff that didn't end up being long for this world, as well as sort of the OpenSeas, which ended up raising at really crazy valuations that weren't supported post the market downturn. And then you had this kind of valley of darkness after FTX collapsed, and there was more or less a sense that the space was no longer investable. You saw all the mainstream VCs, all the generalists, basically, winnow away as quickly as they came. And basically, it was kind of just us. Like, basically the four people you see on the stage, we no longer got invited to cool parties. People no longer, listen to our podcasts. But we kept investing in the space under the thesis that, FTX and the stuff that happened over the course of 2021 was not fundamentally about crypto. It was fundamentally about a bunch of over-leveraged businesses and then one guy who was stealing a bunch of money. And, on some level, the idea that we shouldn't be trusting too much in a particular company or a particular person is kind of the point of crypto to begin with. And we really felt that was obvious, and I think the rest of the world really didn't feel like that was the story that they wanted to take away. And I think with enough time, that story has been vindicated. But if you see of 2022 going into 2023, there was a huge downturn in the amount of venture capital that came into the space. Most of the generalists left. And as a result, there was an amazing vintage for venture capital. Because almost all the investments that we were making were in places where there was very little other capital that was trying to back these founders. And so I think now what you're seeing is this resurgence of crypto. The generalists are starting to pay note again, although the growth funds are out of money. Like growth is kind of dead in a lot of ways. So those guys are not back, and that's for other reasons. Obviously, not just crypto has kind of killed a lot of those guys. But you now see this widespread consensus has been built again that, okay, it probably wasn't the FTXs, it probably wasn't the BlockFis, but there are clearly really valuable things that have been created here in crypto, both businesses and protocols. And you're now seeing both institutional capital coming in top of funnel into things like the Bitcoin ETF and hopefully soon the Ethereum ETF, but also this widespread sense that, hey, crypto is here to stay. And regardless of what you think about individual companies or regulations or whatever, the tide of technology and the tide of capital is moving very clearly in the direction of crypto is real, and it's a real sort of venture investable asset class.
I love it. I love how you brought that up, and I think it's a very good point. Crypto has actually never failed in the last couple of years. It's never been a crypto problem. It's been humans. It's been humans who run these firms. And interestingly enough, and I go back to this because my background is more the traditional finance side. A lot of the times it's traditional finance guys. Like we brought in the Bear Stearns of the world, and we sort of figured out, yeah, we could do something similar. And there's opportunity, right? That was the same thing for Terra. It's going after a peg, knowing how to calculate it and knowing how you could probably bring it down. And I kind of feel like that understanding, and I fully agree with you, I think it's reached a point where people didn't want that to be the narrative. They just wanted it to be crypto bad. And so I love your points there. Paul, you're one of the oldest funds in this space. I mean, surely you've seen evolution beyond what we can imagine when it comes to VCs.
Yeah, no, again, it's been over 10 years now being at Pantera. And, the questions used to be, how many Bitcoins are there? And, what is mining? And, is Bitcoin going to get hacked and all this kind of stuff. And as Steven, you have mentioned, I mean, the technology is real. It works. It hasn't failed us. It's really been sort of human and fraud failure that's sort of put us back. And, I want to echo some of the things that the other panelists have mentioned around, when we started here at Pantera, it took us 3 years to raise $25 million. We went up and down every single sort of road, every single institution, and we were raising mostly from family offices and early crypto and early Bitcoiners. And the space has matured a lot. I mean, what I would sort of say is the highs are highs and the lows are lows, but every single time there's a high, you just get much higher and higher, and there's a lot more use cases, a lot more investors that kind of come in. And right now, I think a lot of the generalist VCs and TradFi VCs and growth stage VCs are still fairly on the out, and we've gotten just more and more strong crypto native investors that have been able to sort of raise their own funds or even just like invest their own prop capital that are really starting to sort of just put a pretty strong, early stage, funding sort of resource market out there. I'd say as the space has gotten much larger, one sort of thing that we're really starting to see is that there's a lot more specialization out there because there's so many different spaces out there. I mean, there's funds that are focused just on Bitcoin. There's funds that are just focused on early stage tokens. There's funds that are just doing liquids. Just to have a separate liquid fund wasn't even a thing back when we were out there, and no one sort of really, there weren't enough tokens really to kind of do a lot of the strategies that we're doing right now. And even there's like more passive investments going on there in terms of like investing in LPing and getting like yield. Athena has been sort of an interesting strategy out there too. I mean, so I would say that again, like you have the ability to focus on certain verticals. Our fund is big enough where we actually have team members that are really specializing in certain verticals. And, with the different strategies out there, I think you're just seeing more and more investors that are coming in and really bring their expertise from traditional finance.
Fantastic. I'm going to come back later on to the points made about institutional capital as well as regulation. That definitely is going to be part of the themes and the thematics going forward. More interesting enough, so VC investing in Web3 has always been that mixture of hype, trying to be with the right trends, looking at cap tables. And I'm not saying this is for all deals, but definitely there is that large majority that goes down this path. And dare I say it, for a lot of times, FOMOing into investments. Maybe not VCs such as yourself who have more established processes, but there are a lot of VCs who still do that, right? They say, oh, A, B, and C, X, Y, Z is on the table. I should be in this deal. Do you feel that we're maturing beyond that? And if so, right now, without giving away too much of your secret sauce that you use internally, what would you rate as proper indicators now when it comes to assessing investments? Paul, why don't you kick us off?
Yeah, I mean, look, I mean, I think there's always going to be FOMO around. I mean, especially if like there's a team out there that people really sort of look at, or a space that like, especially if you're not leading deals, sometimes you just like piggyback off of diligence and things will sort of happen that way, or someone's built up a big brand and you kind of want to like follow around it. But I think for us, like we've gotten pretty institutional in terms of at least our diligence. At least we feel like we have. We have a fairly extensive memo. We we sort of build models to kind of figure out like and underwrite deals, especially on the DeFi side of things. Like I guess you guys might know Cosmo, who kind of runs our liquid book, but he's a pretty strong fundamental investor, and so he's doing a lot of models around all the different protocols. It gets interesting, like GameFi, for instance. Like we invest into a company called Halika. Really makes it easy for you to really look at all the metrics for GameFi assets. And so I think for us, like, with all this on-chain data, we're really sort of able to sort of benchmark not only liquid protocols that we're getting into, but also private protocols, and kind of figure out if the return is, what we sort of expect for, certain size, checks and certain size valuations. So, again, it's a barbell approach for us. We either go in really early and really bet on teams, or we go a little bit later and just build a lot of, data to sort of underwrite things. So that's kind of been our strategy, kind of avoid the middle a little bit.
Fantastic. Who else wants to go next? Go for it.
Yeah, I think I think to answer your question about whether the cap table element is still here, I think it is, right? Like if I see Haseeb go into a deal, I gotta resist the urge to not just write a check right away. And same for the other panelists on this panel as well. I think because crypto moves so fast, right? Especially in the bull market, you have deals wrapping up in 1 to 2 weeks sometimes. And I think last cycle, 2021, I remember some conversations where founders were just like, hey, we have 48 hours before the round closes. So sometimes you don't even have time. So it's very difficult to kind of resist the urge to piggyback off of other people's work. And that's how you have, big disasters happen, right? Like FTX. So I think for disciplined investors, we're always trying to kind of formulate our own opinions. And if we happen to share cap tables with high signal folks that we like, that's just an added bonus. So I think that's something that kind of separates us aside is like as he was mentioning, I think all four of us, we were investing through the bear market, right? We started Tangent after FTX blew up with our own money. We just plowed our entire net worth into the fund because we just thought this is the best opportunity if you believe in the space for the long term. But yeah, there's definitely an element of kind of, herd mentality in venture. So for us, how do we stick to first principles? Because we're so early stage that we try to just focus on the founder. So it's very typical things like, is there former execution, experience with these founders? I think one very important thing for us is we try not to extrapolate past data as well. I think for liquid investing, it's useful because usually you can catch things at the hockey stick point, right? At the breakout point. But the difference with Web3 and Web2 is in Web2, you see a lot of hockey stick growth. Sure, you have one or two that retrace completely. For instance, I think during COVID, we had Clubhouse, where everybody thought this is the future of how people interact, and it just went nowhere. But in most cases, if you exceed a certain threshold, you can basically bet on everything that passes on that threshold and have a decent hit rate in terms of capturing lightning in a bottle. And A16Z actually wrote a pretty good article about this in terms of social apps, right? What is the retention threshold you need to reach in order to know that you probably have a decent chance at capturing lightning in a bottle? I think in Web3, it's much noisier than that because a lot of the usage metrics are incentivized, right? There's a lot of token farming, there's a lot of airdrop farming. So you don't really know what is real traction until after the farming. So if you try to invest off of those hockey stick charts right away, it's a little bit dangerous. So we try to really think from first principles, even when we see those charts. So I think that's one thing that's helped us be very, very disciplined throughout the bear market.
Fantastic. Jason Cam?
Well, I think we do FOMO sometimes, often. I think the quick unspoken secret is if the cap table is really good and the narrative is really good that you're like first of this lane, it almost guarantees a top centralized exchange listing, which translates to $1 to $2 billion FDV. So if you get there at 30 to 50 million bucks, like you just print money, and that's why everybody FOMOs into these deals. It's just about making money. So it's hard to fault all of us for sometimes doing it. Hopefully, it's not brand damaging when we do it. I think with us, we have a smaller size, so it's beneficial, I think, compared to Paul and Haseeb, when sometimes they are forced to really play the strongest, the biggest, the top narratives. We can hopefully go earlier with smaller check sizes. So I think size is sometimes the enemy of excess returns. But they have executed incredibly well. And I think we tend to historically really focus around application stuff. And that allow us to bet on more non-consensus, edgier things, and allow us to be a little pickier on how well the founder typically execute in this sort of consumer lane, and then be a bit more picky about whether having Web3 and incorporated is actually logical for this product. Once we sort of fit that in, I think we generally get to things that are slightly lower in valuation. And if they work, they really work well, hopefully. The other nice thing about consumer products, and I think we're going to start to really see it, is that typically if these things are going to work right out the gate 3 months after development. Versus typical infrastructure projects, you kind of really need to talk to Vitalik, you got to pick size, you got to talk to 2P relations. Consumer, we felt like for Asian developers in particular, they can kind of self-contain the development within their own team, and you typically find out right away. So the quick iteration with all the edgier picks that we have at lower valuation historically has been the edge. Hopefully will be the case going forward.
Fantastic. And I mean, Haseeb, to tweak it slightly for you, FOMOing into investments is probably not a Dragonfly thing, since normally you guys lead the rounds. I think the only thing you've probably FOMOed into is a microphone after seeing Jason's one. I get that. I have that vibe now that I should go out and get one for myself. But maybe beyond that maturation aspect, and is there a shift in how do you look at for the indicators? I think founder is a good point, right? And we've established that it's always going to be key. But are there other things that you think as we grow as an industry, as more data becomes available, there is something that you can actually calculate it in terms of formulae of how you would look at it?
I would say if you're looking at the early stages in crypto, it's hard to be too exactingly numerical or too exactingly data driven, right? The reality is that the most valuable stuff in crypto is really 0 to 1. You're creating something new, you're defining a new category, you're inventing some new idea. And if you are narrowly hewing to, okay, I'm like X, but I'm 20% better, I have this better formula, I have this better, invariant or whatever it is, those things sometimes work, but most of the time they end up just kind of drawing a very small part of a currently existing market. And almost everything that's been really kind of generation defining investments in crypto, whether it's like Solana or Uniswap or Eigenlayer, these kinds of things, they really create a whole new territory, right? It's like discovering new land or a new continent. And those kinds of investments, very, very seldom is it about, running the numbers and, creating some matrix of potential outcomes or something, especially not at the early stage. At the early stage, it's really a matter of you having sufficient imagination to understand, is this thing really possible? Or am I being fed a bunch of bullshit? And there's a lot of startups that are feeding you a lot of bullshit. And so on some level, when I think about what makes really great investors in crypto, I've been doing this for a while now, and I've seen people who I thought were going to do really well and ended up becoming terrible investors, and people who I thought were going to be terrible and ended up becoming great investors. And I'd say the number one thing that I think ends up defining really great investors is that I think in crypto, actually, it's that they're very stubborn. And it's kind of weird because stubbornness is usually associated with being a very negative trait. But what I find is that in crypto, you kind of have to learn at some point. And for most people, it takes a very long time to get there. But you kind of have to learn at some point that you, the investor, are smarter than the market. That the market is stupid. The market doesn't understand what you understand. And you have to, at some point, believe that you can see the matrix of this narrative is bullshit and it's going to die on the vine. This thing is real and the world doesn't see it yet. And you kind of have to be willing to go through, again, that kind of dark night of the soul of, whether it's Kyle believing in Solana at a time when everyone else abandoned Solana, or whether it's the people who are, looking at Uniswap at a time when Uniswap is doing almost no volume and saying, I really think this thing can totally redefine the way that trading is done. When all the smart people, all the smart traders who would tell you, there's no way, it's so inefficient, it's the RFQs are going to kill it immediately, who are able to really see something that nobody else was willing to see. That thing, whatever that is it's really hard, especially when you're a young investor, you first get into the space and you want to take solace in the consensus of your peers. But almost nobody who made really, really amazing investments in crypto was part of the consensus when they did that.
Well, it's very daunting if a young kid, like 22-year-old, and then he pitch against Haseeb, and Haseeb's like, this is complete bullshit. It's like the good investors in the space, like Kyle and Haseeb and Paul, they tend to be very eloquent, very logical, very thoughtful. So and you're a young buck, and you're like, oh god, maybe I really missed something. So it's great advice. I think it's really, really hard to do.
It is.
A good example of this is also Athena, right? Because they started not long after UST blew up. So the entire world, including crypto natives, were incredibly skeptical of any stable coins, including USDT and USDC, because we had those scares last year as well. So when we were looking into Athena, I think alongside Dragonfly, we kind of saw a founder who was very contrarian. So I think what Haseeb mentioned also applies to founders in terms of having a very stubborn vision that you just the entire world's telling you you're wrong, and then turns out, so far they're correct. So that has been, I think, the prototypical example of, a stubborn founder and stubborn investors just partnering up. And so far they've been doing quite okay as well.
Mm-hmm. I like that.
Fantastic. So I love the fact that you're all getting along and everyone's friendly, paying each other's back, looking up to each other. But there has actually been an underlying theme that's actually been the answers for all of you here. And interestingly enough, it's almost turning into a tennis match, like 2v2 to an extent. And this goes back to that concept of the VC space itself becoming crowded and flush with capital, the large versus the small. I think there are benefits, pros, cons to both sides of it, but I'd love to see your thoughts, all of you, in terms of what do you think? Is there really an optimal, or are we in a world where there's enough niches that they almost can stay in lane, so to speak, and can run and grow an ecosystem when it comes to sizing of VCs? Paul, why don't you kick us off for that? And actually, Haseeb, kick us off for that one, since everybody wants to hear your opinion on that, I'm sure.
I mean, I'd say, I think right now it's kind of a barbell, which is that, okay, I mean, if you're, well, I don't know what you would call that, but if you look at the very extremely large funds, whether it's Andreessen or, when Tiger was investing in crypto or Kotu. When you get too big, you sort of become a taker, right? You're sort of forced to pay whatever is the market price in order to invest in a deal that's of sufficient size that you can deploy your fund. And I think that really ends up being a massive drag on returns, right? So you still want to have the ability to pick and choose among what spots you're going to take and not be constrained to like, hey, well, I got to turn around this fund within 2 to 3 years. So I kind of have to make this investment regardless of price. Now that said, so I think, so there are a bunch of funds that are kind of around the Pantera size, the Dragonfly size, there's the polychains, the electrics, the standards. And so there's sort of like this range of the kind of the big funds. They lead a lot of deals, but they're not like obscenely big such that they're kind of forced buyers, right, of a lot of these investments. Then you've got this kind of no man's land of like, sort of 200 to 300 million where you don't have a lot of fees. You can't support a very large team. You can't really build a huge brand at that size. You can't really have a big platform team. So, Paul was talking about, the recruiting work that, a lot of the big funds do. They help with, helping you with go-to-market, helping you with security, economics, tokenomics, all that kind of stuff, right? If you're a $200, $300 million fund, you can't really do that. You don't really have the muscle to be able to support something that big, but you still need to lead rounds because you got to write, $10 million checks to support a $200 and $300 million fund. And so you're competing with me, you're competing with Paul, and you might not have the eloquence, if you're running a fund of that size. Now then you have the sort of smaller funds, like I'd say what the Jasons are representing, and there you can really return the fund on a single $2 million check. And for Paul and I, that's really hard. It's very difficult for us to return the fund on a $2 million check, but these guys absolutely can. And so I think the small end really, really, the economics are just fantastic to do a stage of round that is just not as competitive when you're talking about pre-seed or like really early seed. Whereas like the places where Paul and I are playing, they're extremely competitive. We are fighting the biggest dogs out there to try to win the rounds that we're playing in. And then I think I'd say that area in the middle is the toughest area, I think, to make really great returns, just because of the adverse selection at that size.
Fantastic. Jason, Choi, your thoughts?
Yeah, no, I absolutely agree. I think that is precisely why I started Tangent with my co-founder, is because we were surveying the landscape at the time. We thought, okay, if we go out and raise a fund, if we raise, $100 million, there will be so many other $100 million funds we need to fight. If we try to play the big size, then we're really entering the arena with like some of the smartest and biggest and most well-capitalized funds in the world. So both my co-founder and I are deeply, deeply competitive people, but we both also hate competition. So we naturally gravitated towards what we thought was a blue ocean at that time, which was very early stage, completely prop, so we can be fully flexible with our mandate, right? If venture turns out to be a horrible environment for the next 3 years, we can just play the liquid markets as well. So that ended up being a very, very good call. At that time, it was a very contrarian call because everybody thought we were crazy to kind of go with the kind of micro fund model and bet with our own money. But in hindsight, I think the competition is definitely less in the earlier stages, especially if you have already created a track record, right? So both my co-founder and I, we came from two of Asia's largest funds. So I was a partner at Spartan Capital. He was a principal at Defiance Capital. So we already have that massive network in Asia in crypto, which nobody else had. So that allowed us to kind of basically win every deal that we wanted to get into without needing to fight for allocation. But even if you have our network, if you're operating at like 10, 20, 50x the size, that alone might not be sufficient, right? There's a lot more competitive forces at play.
I mean, Paul, and on to Jason's points, and Paul, you mentioned it earlier on. Do you think that Pantera being so old in the space, plus the accessibility to alternative asset classes besides just crypto, is that something that we're going to see more of? And I mean, is that what the larger funds should be doing, in your opinion? Diversification of risk to an extent.
Yeah, like look at like exactly what Haseeb mentioned. I mean, like I can't do $1 to $2 million checks anymore. And those used to be the funnest one to do, right? I mean, it's just like betting on teams, trying to bet on founders that have these huge visions that are contrarian. And I think for me, I am I'm a taker at a series A sometimes, but nevertheless, I mean, I think there's still an opportunity to kind of go out there and bet on founders that raise more sizable rounds. Sometimes I make those rounds a little bit bigger so that I can get more, a little bit more of a check in there too. But I think, look, I mean, I think there's a lot of opportunity at the earliest of stages, and Jason can do very well there. I think Series A's and B's just get really competitive once you start getting a little bit of traction. And me and Haseeb fight each other for leads, and it's extremely competitive. I do think beyond Series A's, Series B's and beyond get a little bit more difficult too, because like once you actually do start having product market fit, the valuations just get fairly out of control because there's not too many of those companies that kind of reach that sort of stage and sort of that market validation that this could be something something really special. And so, I think that's where you really sort of have to take what the market gives you. You see Andreessen and Paradigm putting these multi-billion-dollar rounds where they're really sort of at a stage probably like before. And so, yeah, it's tough to make a lot of good returns if you do a lot of those. And if you have a fund that's that big, you really do have to create more of an index play on anything that sort of reaches that stage, and it becomes really difficult. I mean, that's why like we've sort of avoided that like sort of Series C, Series D strategy, and kind of have gone after more of like sort of discounted secondaries to kind of fill that gap, or even like going into liquids. That's always a way to fill that gap too. But I do think like as this space gets bigger, we are going to need growth funds to kind of come back, unless like everybody just launches a token and goes public that way. But again, there's going to be a lot of infrastructure projects, a lot of heavily regulated projects that aren't going to launch a token, and we need sources of capital to kind of fill that later stage gap. So that's probably where we need more of later on. But it's also a good problem to have. That means that we're succeeding in creating equity value.
Fantastic. And Jason, as the Rocky in the room, how do you feel? The heavyweights around you.
Look, I think these guys covered it well. I think the most disheartening thing usually is Jason Choi can be everybody's friends because they punch so much above their weight in terms of check sizes that like everybody want them in the round. Whereby for us, like we need to cut $1 to $2 to $3 million checks for it to matter. But those for really hot early stage projects, we have to really fight. Sometimes we don't even get to look. So it's like challenging. So I think how we would compete is difference in geography and then difference in vertical. I think Ifina is a really good example. It's not easy because it's like a hot DeFi, like kind of edgy, but really solid initiative. But if it's like a Chinese consumer play, it's much easier for us to claw what we want. And the other thing too, I think what the last point I would make is I think in crypto, unlike traditional venture, sometimes it's really capital intensive. I mean, you spend massive CAC to get to scale at a SaaS company. Whereby in crypto, I mean, there are only that many funding rounds, that much capital needed to reach product or narrative market fit, and then you get listed. But I don't think we've seen things like Uber equivalent where it just, I don't know, gobbles down billions of dollars of capital, most of which are VC funded, to get to a stage where they get listed on NASDAQ. So I think eventually, if the space matures, we'll get to a stage where some companies will need billions of dollars. And that's where these like sizable funds that Pantera and Dragonfly had built really comes into play. And we just can't compete there, I think.
Fantastic. No, I love the approach and love the opinions. It makes a lot of sense. And it does show that technically we're still so nascent that we have a long way to go before this place matures. And the fact that a lot of your respective funds are looking in the liquid side of things, I remember in 2021, that wasn't common. It was one of those things that seems to have evolved, and I think it's really good for the market, right? It's a show of faith, so to speak. Jason was talking about the evergreen concepts as well. I think that comes to light there. So, interestingly enough, in crypto, and maybe let's be a bit more forward-looking right here, we've witnessed quite a few false starts in the last, I would say, 1 to 2 years. False starts in terms of people trying to get the right narrative of the next hot things. I mean, DeFi went, sort of rebuilding itself right now. Deepin is now coming to the fore. For each of you out there, what excites you the most from a thematic point of view, both within the next 1 year and in your mind what you see 3 years from now in terms of the space? Jason Cam, can you kick us off?
Yeah, I think my opinion is, I've been touting this horn for a while. It's always like 12 to 18 months away, but I'll keep saying it. I'm quite bullish based on the infra that's being built, the two consumer entertainment products. And the checkboxes I have are, either high production value, innovation on entertainment product itself, or really innovation around Web3 financial aspects. And you pick two, and if it's just production value and innovation on gameplay, it doesn't have to be in Web3. So you're kind of only left with production value plus Web3 innovation, or real innovation on sort of gameplay dynamics, entertainment dynamics, plus Web3 components. And that sort of leaves you with either Web 2.5 games and applications, or sort of these really fancy, interesting, crazy friend.tech, financing.top, pump.fun type products. I think the infra and Paul and Haseeb can tell me if they're ready, but we're really getting to a place where with the modular or high throughput blockchains, with Privies of the world, with fiat and off-ramp, I mean, really sharp consumer teams, 4 or 5 people, can spin up a product within 3 to 6 months and really start going and generate 5, 10, $20 million of revenue with maybe dangling a token airdrop carrot, but nonetheless, really revenue generating. I really think we're on the verge of something there popping up and really capturing mindshare. And hopefully the mobile infra is kind of ready for us to get some adoption. So that I'm really, really excited about.
Fantastic. What about you, Paul? Mobile infra. I mean, you mentioned mobile apps. That's how you start looking at the space as well. So
Yeah, no, I mean, I think mobile should be very big for crypto. Maybe it comes through the Solana phone, who knows? But, at the end of the day, we have to sort of get the experience right and, kind of go through whatever sort of paywalls that kind of come about from being on mobile. But, that I think what kind of gets us kind of like to a larger user base is probably the combination of mobile plus this, whole concept of crypto under the hood. And, it's a concept where folks really just, I mean, FTX kind of got us a little bit of that, but like, folks don't really need to know that, there's, USDC in the background, or folks don't really need to know that blockchain is being used in the background. But at the end of the day, I mean, blockchains can sort of enable ownership of items and be able to sort of create more value for individuals, creators, institutions, things like that. And so, one area around consumer that we've been sort of looking at would be around sort of the gaming side of things, or maybe even sort of like the NFT loyalty side of things. You guys have probably heard of Blackbird, which is sort of like restaurant loyalties, where you can sort of, get rewarded with these, sort of NFTs and be able to sort of like trade them rewards, or maybe something like a claim.co. But it's really sort of reinventing like user acquisition and advertising with rewards that sort of count as NFTs and sort of have value where you can sort of have them be traded in a secondary marketplace. And I think things like that are and have it be more fungible within sort of like other types of loyalties and rewards. And so, I think things like that are going to get, the next like huge wave of users in, but they don't need to sort of think about crypto. They don't need to think about like the sort of, brand that crypto has been associated with in the past. And they really think about crypto sort of enabling something that's fun, something that's engaging, something that they can get more value out of. And so, that starts off with like things that are fun, like NFTs, or maybe even, I guess the other thing that we've been investing quite a bit into is around stablecoins, stablecoins for payments. But again, all under the hood where it's facilitating, cross-border payments, which is a tremendous market. And we've invested both into the on-ramp and off-ramps, plus also sort of the API layer that kind of moves money around. I think one of the things that Dan is really sort of pushed for is, if we've had, Skype, voice over IP, I mean, really crypto is money over IP. And, that's the biggest use case that, got me excited, was really sort of bringing financial services, bringing access to sort of money and be able to sort of move money globally without intermediaries. That's the promise of crypto.
fantastic. Jason Choi?
Yeah, I think our thesis is quite similar to what Jason Cam was mentioning as well, which is the focus on applications, right? Because if you look at the top 20 most valuable crypto assets today, only one is a consumer-facing app, and that's Uniswap. Everything else is like an infra, meme coin, stable coin, So that makes no sense to me. I think that can only last for so long, right? You need users to eventually come and you need the market to put a value on these applications. So I think a large reason why this is the way it is because of the Fat Protocol's thesis, right? Way back in 2018, we've basically decided as an industry that infrastructure will be capturing all of the premium. But I think over the past years, the lines between apps and infra are starting to blur, right? You start to see things like DYDX becoming their own chain after they have, a critical mass of users. Every game is trying to do their own L2s. And so every single app, the moment they get some users, they realize, actually, we have the power here. We have the market power to verticalize and become our own infra. So I think the lines between infra and apps are blurring. And I do think the alpha is actually to look at where users are, because whoever owns the users, it's the same with like Web2 aggregation theory. Whoever owns the users, you basically have the power. I don't think that's actually that different in Web3, or at least not as different as we thought, just a few years ago. So in terms of, what type of apps we're looking for, if you think about building things on crypto, you rarely build things on a blockchain to make it faster and cheaper. Usually it's the other way. If you move your app onto a chain, it's slower, it's clunkier, it's more difficult to use. So I think the thing that actually gets people to use a clunkier version of a Web2 app is something that you can't do on Web2, right? So a lot of this comes down to financialization. How do you create things that is just simply not possible in Web2, money games that you cannot do in Web2? So we start to see things like Fantasy Top, which is basically a marketplace for influencer engagement. And then you have FriendTech, which is a marketplace for influencer access. And you have Polymarket, which is a marketplace for any outcomes. So I think a lot of these apps would kind of look like marketplaces, look kind of like casinos, but not fully. I don't quite like to call them social-fi, but that seems to be what people are calling them these days.
Fantastic. Haseeb, your thoughts, sir?
Yeah, it's interesting because Jason seemed to be claiming pretty roundly that the market values blockchains, layer ones, layer twos, almost as like a conspiracy based on a blog post 6 years ago. I will take the other side of that. I think that the market correctly values infrastructure, layer ones, layer twos, as being very, very valuable. And yeah, it's true that there's only one application in the top 25 most valuable crypto tokens, which would be Uniswap. And I think this is in large part not because the market is being unfair or it's not being nice enough to applications, but I think it's because in some sense, we've already found the killer applications for crypto, and the killer applications for crypto are mostly just sending money and holding money and tokenizing assets, putting them on the blockchain, whether those assets are stable coins or tokenized stable coins or whatever other kinds of financial assets that we move around on chain. But at core, most of the valuable stuff that crypto has really created has always been about money. Whether it's the very beginning of Bitcoin being about digital gold, or whether it's Ethereum saying, okay, well, we're going to allow you to program that digital gold, or ICOs being decentralized capital formation, or DeFi being decentralized trading and lending and all these financial primitives, or NFTs being a non-fungible financial asset. But at the end of the day, almost everything that's really valuable has been about some form of financial asset. And although I do believe there are going to be applications that will be very big, and there are many of them that we've invested into, I think the market is telling us something important when it tells us that, hey, the substrates on which this economic value is going to run, those substrates are going to be really freaking valuable. And unlocking the gap between where we are today in terms of the scalability, the usability, the security of the chains that we use, they're pretty good. Something like Solana or Near or AVAX are a big improvement over what Ethereum built 7 to 8 years ago. But there's still so much farther to go in getting things to where they need to be to onboard tens of millions of users. 10 million is too many for any blockchain today. 10 million daily actives, that's just beyond the reach of blockchains today, which is crazy. That's not a big number in absolute terms when you think about Web2 kind of consumer applications. So getting to 50 million or 100 million is going to take really massive changes from where we are today. And so that's the area that it's kind of boring because it is a little bit samey to say, oh yeah, more layer ones, more layer twos, that's really the answer. And for me, I think emphatically the answer is absolutely yes. We are nowhere near where we need to be for these things to be, if you imagine what blockchains are going to be like in the year 2040, they're not going to look like the blockchains that we use today. And so that's very much a space where I spend a lot of my time and my energy.
Fantastic. I love it. I think we have time for probably one more question. I'm going to shift gears a little bit here and go to something which seems to be pretty hot in the space. We're seeing a lot in Asia, and obviously recently there was a massive success on this node sales. That seems to be the route that a lot of projects now are moving towards. And I see Jason Cam has this look on his face. I'm sure he's got an opinion on something like this. What's your thoughts?
Me?
Jason Cam, what are your thoughts?
No, notes up. I mean, the teams need the capital, so they sell these notes. I think it's good business decision. I don't know what those notes are for, but if they get some capital through that, good for them. That's my answer, I guess.
Very politically correct. Love it. I'm hoping the other Jason can give me a bit more enlightenment on what your thoughts are on that.
I don't think it's that. I think every other month, crypto seems to come up with a new gimmick to raise money, but it's the same shit that's been around forever. Like this month, everyone's talking about KOL rounds, but those things have been happening since like 2017. So I think node sales, if you're selling a node, what do you get with the node? You just get more tokens. You're basically also just selling tokens, but a derivative of the token. So I don't think there's anything that is groundbreaking to me. I personally haven't bought any nodes. Maybe I'll get red pilled if I finally buy a node, and maybe it's really life changing. But so far, it doesn't seem like anything we haven't seen before.
That's it.
Yeah, you did
Haseeb,
say usually, yeah. I did say usually I don't FOMO into things, but node sales, the one thing that can get me to FOMO is a good node sale.
Yeah, it's real.
Everyone loves a good node sale.
But do you think we're going to see some fatigue in this? I mean, I think I was asking the team internally over at GSR, and recently I think we see something like at least 10 to 20 node sales coming up in the next like 2 to 3 months. Will the
You see
street
10 to 20 node sales?
Wow.
Who is doing all these node sales?
That's welcome to Asia. There's a lot of that sort of stuff going on out here.
I don't understand.
Which is why my question, right? It's why my question, because I love what Jason has just mentioned, right? It's almost a derivative of what is originally there, right? It's like another means to that pathway. But is it overcomplicating? Is there a need for it? Is there a use? I mean, what are your thoughts? I mean, node sales weren't the most popular things back when Haseeb, you started, neither did you, Paul, and suddenly it's out of the blue. So what are your thoughts on it?
Yeah, I mean, look, people are endlessly creative in finding ways to raise money and to tell new stories. And in some level, our job as a VC is, I sort of said it before, to like see through the matrix and, kind of use your X-ray vision to be like, okay, they're calling this a node sale. They're saying that this is, the liquid intelligence. They're coming with all these like weird new ways to describe what is actually a pretty mundane concept if you actually understand it. So what are they actually doing, right? They're calling it a node sale. What the hell is the node? Okay, it's a token. Okay, what does the token do? Okay, it's a token for this network. What does that network do? And usually, especially the worse a project is, the more confusingly they're going to explain to you what they actually do. And a lot of the work, as you spend more time in crypto and you really get your reps in analyzing these protocols, you just start to like, okay, you see this pitch and you just kind of winnow it down. Aha, I know exactly what you're doing. That's interesting or that's not interesting, and you can figure it out pretty quickly. If it's your first time in crypto, if this cycle is your first rodeo, strongly encourage you, do not buy any node sales. Go buy some Bitcoin, buy some Ether, strap in, and like, try not to buy anything you read on Twitter, because that's a formula for pain.
I can see the Twitter trolls already going to comment on this thread. And Haseeb, you don't know anything. Stop flooding my bags.
Let them come at me. I'm ready for it.
Paul, what are your thoughts on this?
No, I think everybody said it. I mean, look, if something is novel and new and a bit out there, do your research, get to the bottom of it, and don't FOMO. So that's pretty much it.
Fantastic. Look, we've got 3 minutes left. Any parting comments for the audience? Be it the share of the fun, what your thoughts are, how much you've enjoyed today, for instance, and then anything. Haseeb?
This was great. I will say I do FOMO into anything when I see someone named Jason is investing. I don't even check the last name. I instantly write them a term sheet.
Jason, come. Your thoughts, sir.
I mean, I respect all of you guys tremendously. I think the crypto space currently is in a slight dearth of narratives. I think the space looks for new stuff, whether it's a crazier money game or a new vertical being spun up. if you're doing something edgy and really crazy that's out there, I mean, hit all of us up. I think we're really looking for something that's out there.
Fantastic. Jason Choi?
Yeah, I feel like I always have this feeling, but I feel like we're on the precipice of crypto being center stage again in the mainstream, right? With crypto being more and more political as well. So it's starting to enter the mainstream again. So I feel like the next 12 months will be a crazy, crazy time in crypto. So if you're in this industry, just strap in. The lows will be more horrible than you expect. The highs will be probably better than you expect, hopefully. But either way, if you're building something interesting, especially something that I mentioned just now in that vicinity, definitely just feel free to reach out to me on Twitter.
Cool. And Paul, round us off, sir.
Yeah, no, I mean, I think domestically we're focused on, you know, a lot of institutional on-ramping stuff. So if you guys are doing anything on that, let me know. Actually, in Asia, I probably should be working more with the Jasons, but we are trying to look for more consumer related stuff. You know, I know that it's not going to get to like 10 million daily active users yet, but you know, even if it's like forecast at 80,000, something that's starting to get some traction where people can actually try out and learn about crypto and do so. You know, maybe it's like, you know, tradable stickers on Telegram or something like that. I mean, like I'm always interested in like some far out ideas on the cryptos on the consumer side of things.
Fantastic. Well, ladies and gentlemen, that's all we've got time for today. I'd like to say thank you to the 4 panelists, all times of the day for you, those in Asia, those on the West side, Western Hemisphere. It's been a real pleasure, this conversation. I've really enjoyed it. And hopefully we get to meet each other at different conferences going forward. Thank you very much, SCB10X, for this.
Thanks for having
CJ.
us.
It was great.
Thanks,
Thank you so
everyone.
much.
All right.
Thanks,
Thank
CJ.
you.